Good afternoon and welcome to another session of Ask Emirates NBD. Today we've got the expert team from Emirates NBD Asset Management. These are the guys who run the investments in the equities and the fixed income and the money markets. So today we'll be asking you to give us some questions. We'll be discussing movements in the local markets, asking you for questions to come and give us some feedback, things that you want to know, things you want to learn about investing, any questions you've always wanted to ask and never got around to. This is your opportunity. My name is Steve Corrin. I look after the sales and distribution for the asset management business. I'll introduce the team. On the far right, we have Marwan Haddad. Marwan looks after our equities business, investing in the UAE and GCC countries like Saudi, Kuwait and Bahrain. In the middle, Angad Rajpal heads up our fixed income business. He invests in the bonds and the fixed income, again from the same sort of region, right up as far as Egypt, down to Saudi and UAE. Vinod Bhatia has been with us about 11 or 12 years. He looks after distribution into the banking channels, has a great knowledge of retail banking products and how the retail client segment works. So hopefully he should have some good insights for you as we go along. Please do send us some questions as you go along. Please be reminded also that we're not handling complaints today. Any complaints will be handled slightly after the session. Today is about an interactive discussion to try and learn a little bit more about investments and how you can benefit from the markets in your own personal finances. So with no further ado, I'll move on a little bit. The Emirates NBD asset management business may not be familiar to many of you. We sit in DIFC, we have about 50 people. We've been there about 15 years. We're one of the largest asset managers in this region. We manage money market investments, we manage equity investments, and we also manage fixed income investments. We manage those investments for lots of clients around the world, predominantly in this region, but also much further afield. I'll ask Angad just to give us a bit of a breakdown as to when we're managing those investments, what are we trying to achieve and how do those investments really benefit the clients that we look after?
All right, thanks Steve for having me on this panel. As you rightly pointed out, we are an asset manager who manage money for institutions, for retail investors, and the way we provide access to the investors is through multiple channels. We have publicly managed funds where retail investors can subscribe into those funds. We also have bespoke solutions, so depending on the amount of money that investors are looking to allocate into strategy, we create bespoke solutions for them and they could invest into those. The strategies or the funds that we offer to clients to invest range across multiple asset classes, from equity, fixed income, both within the region as well as outside the region. So okay. I suppose that answers your question.
From an investment perspective, that's really useful. And I'm thinking for the audience that we've got today, many of those audience personnel will be retail investors. So maybe Vinod, can you give us a bit more background as to how can retail investors use us? What sort of access does a retail investor get to our business?
Yeah, so for a retail investor, we've got a range of funds which are domiciled in Luxembourg. Mm-hmm. These are off-the-shelf products available through our distribution channel. Emirates NBD is our largest partner, and all clients could go across to the Emirates NBD branch, to priority banking, personal banking, business banking, private banking, and access those funds. Investments are not very large, don't require a very large investment to start off with. You could, and there are products available where you could even start with as low as $250 a month, okay, and invest up to whatever amount that you like.
So you don't need to be a millionaire?
You definitely don't need to be a millionaire to start investing.
Okay, but do we turn millionaires away?
Hopefully, yes.
We keep the millionaires coming. So obviously the markets here, we've got equity markets, we've got fixed income markets, and they go up and down as all markets do. And I guess what a lot of retail clients would want to know is how much should they invest? You know, if someone's earning, let's say someone's earning 20,000 dirhams a month and maybe they've got 100,000 dirhams in savings, you know, how much should they invest? And it's an interesting question for everyone has a different answer, and I'd just be interested in Marwan. I know you look after the equity team. You've been in the industry about 12 years. For a retail investor, what would be a good indication or a good benchmark about how much they should invest?
Well, Steve, it's a tricky one because it relative from one person to another. But I would say the rule of thumb, always keep around 6 months of your expenses as in a kind of a safe account, which is more of a cash account. And anything beyond that should be invested. If you have accumulated wealth beyond that, should be invested in different asset classes.
Okay. So I think that's really good advice. You know, people should keep an emergency cash buffer, 6 months of salary at least, and the rest can be invested. On the back of that, please do send us any questions you have. You know, about what should we invest in? Is it equity markets? Is it fixed income markets? Please do send stuff on the social media channels that you have. Any questions, we'll address them. Obviously, anything more technical or complaints, we'll come back to at a later date. But for the team here today, I'm interested from your perspective, Angad, because a lot of clients say to me, well, okay, I've got some money to invest. I want to make the highest return with the lowest risk. And everyone says that. But realistically, what should clients aim for? Because we know that's not possible. They need to get a balance. So what's the difference between investing in equities and fixed income?
Yeah, I think it's a good point. So what the clients need to realize is the highest possible returns potentially also come with the highest possible risks. So what as it all depends on your individual circumstances, where you as an investor have the appetite, the risk appetite to go on a much higher risk, you could potentially target much higher returns. And you have to look at the full spectrum of investment opportunities that are available, from equity, which historically have one of the highest risk profile, to something as easy as a cash deposit or fixed income, single name bonds, which do not have as much risk associated with those, but they give you much more steady returns. What the investors have to bear in mind is any allocation to investments that they make has to be a diversified portfolio of various investments. So we wouldn't be recommending investors to simply just invest into equity to get the highest possible returns, or investing only in bonds just to get the more sort of steady returns.
Okay. What sort of period? I mean, Vinod, you deal with a lot of investors. How long should people expect to tie up their cash for?
See, ideally, it would depend upon the goals that an investor would have in mind. I mean, if you are a 35-year-old individual planning to save up for retirement, then you can't really have a goal which is one year out or 2 year out. You have to have your investment horizon that spans that long. But in most cases, you could invest into fixed income with a typical 2 to 3 year horizon, and in equities with a 5 year horizon. But then you need to keep reinvesting your investments periodically to check if they are still aligned with your goals, or do you need to rebalance?
So 3 to 5 years is probably a reasonable time period. If you've got cash to put aside for 3 to 5 years, that would make a little bit more sense, rather than investing for 2 months or 3 months. That's far too much on the short-term side. And in this part of the world, we have lots of different types of clients. As a business, obviously we run a lot of institutional money. Marwan, I'm just interested to know, a client that's investing $250 a month, is he getting access to the same expertise as an institution who's giving us $20 million?
Oh, well, definitely, Steve. To be honest, I think maybe even better because we pull these funds into, or this amount of money into the fund, and it's managed in the same manner, and it's being allocated the same resources as institutional clients. So I guess that's the creativity of having these funds as a tool, which are give clients much better access.
Great. So they get the benefit of that institutional experience for very small amounts.
Very true.
That's very, very useful. And what about Sharia compliance? A lot of people in this part of the world cannot invest in conventional formats. So, Angad, what do we have that can help the Sharia compliant investor?
Yeah, that's a good point. So this part of the world, there's a lot of significance for Sharia compliant investments. At Emirates NBD Asset Management, we offer a full suite of Sharia compliant products ranging from regional equities to emerging market equities to Indian equities to global fixed income. As well as to real estate. So it doesn't matter if you're a conventional investor or a Sharia investor. The range of products that we actually have caters to all the needs.
Perfect. So I hope that's giving everyone a good understanding of what we do. We'd like to see some questions. Please send us some questions. We've got some good experts on the panel here. So any questions you've got about the equity markets, the fixed income markets, how kind of investments you should make, please send them across the channels. We'll address them with the teams right now. Some of the questions that I get asked is, I meet a lot of people who've lived here for a few years and they say, listen, I don't need to save for retirement. I'm not going to bother. I'm going to spend all my money on cars and boats and TV systems. You know what? Because I've got end of service gratuity coming. When I leave the business, I will get a nice big lump sum and I'll use that for my retirement. What do you guys think? Do you think that's is that a good strategy, Vinod? Do you think it's a good strategy to rely on end of service gratuity?
Chances are that end of service gratuity would not suffice to meet your retirement requirements, purely because between now and then inflation would be far ahead of you. What you think right now is sufficient would never be sufficient at that point in time. We have had cases where we come across with investors who at that point in time find themselves short and then struggle, and then you need to either extend your work life or you need to compromise on your lifestyle, neither of which is a great idea.
I think, so what the message is really to the end of service gratuity is a nice thing to have, but it's really not going to be enough to satisfy a proper retirement. You need to do a little bit more of your own personal savings into more equity or fixed income markets. We've had a question in from Instagram, Zedri. What are the views of Emirates NBD of investing in cryptocurrency? Wow, cryptocurrency was popular about 18 months ago and it was shooting up to, I remember Bitcoin was hitting sort of 18, 19,000. I think it's now down to, I don't know, 5 or 6,000. So very interesting asset class. And I think I'll be interested to hear the views of some of the guys here. So I'm going to start with Marwan and just see your views on cryptocurrency, Marwan.
Well, cryptocurrency is a large word, Steve. To be honest with you, I think that the technology itself is very useful, but to what extent the currency, I think we yet to see that happening. You've seen the volatility in Bitcoin as an example, and all other currencies. I don't see I would say the utility of it as a currency yet. It probably is going to facilitate a lot of transaction in the future, but at this point in time, I think few will survive. So we need to see who will survive, like the internet age. You know what I mean? Like few survive, like the Googles, the rest. I don't know if that answers his question, but.
What about you, Angad? Have you had any conversations with any clients about cryptocurrency? Any thoughts about it?
Yeah, we keep getting these questions. I mean, cryptocurrency as an asset class, if it is one, is still in its infancy. I think, Steve, in your preamble and in your introduction to that question, you actually explained how volatile this particular asset class has been, or what the price of cryptocurrency is. It is so far not a very well tested asset class. We would highly recommend investors to be very cautious investing in cryptocurrency. And I think as a house at this point, we have no direct involvement as far as a product is concerned on cryptocurrency. But I think from an investor standpoint, it's interesting to see the actual technology underlying the cryptocurrency in terms of blockchain. That's where we feel that there would be a lot more opportunity for investors.
Great question. Thank you, Zedri. Thank you for sending the question in. Everyone else, please do send us any questions you have. Send them through the social media channels. You've got some experts on the desk, so please do fire us in some questions. On the other side, cryptocurrency, if you think about cryptocurrency as being sort of the new kid on the block and the high volatile technological investment, let's dial back to one of the oldest investments on the block and what's very popular in this part of the world, gold. I know many investors talk to me about buying gold. They call it an inflation hedge or whatever it might be. You know, and I've seen gold as high as 1900, and you know, today it's down about 12 or 1300. So, you know, that's a really interesting conversation for me. Lots of investors ask me about it. So, you know, I'm interested on the panel's views on gold. So maybe I'll start with Vinod and just ask what's your view, or what conversations do you have around gold as an investment?
You see, gold does come up in many conversations, and as you said, it's a very popular investment vehicle, someone may call it that in this part of the world. My opinion is gold is a very good hedge and has a part to play in a portfolio, maybe 5%, maybe 10%, but that's about it.
Yeah.
It doesn't give you any income. The capital appreciation on gold is at best linked to inflation. You can't really make wealth out of gold.
It's a good point. It's a good point. There was a very famous Warren Buffett quote many years ago, and he said, if you take all of the gold in all the world and put it in a big block, it will form a block, I think, about 30 feet cube, which you could put on a football pitch. For the value of that, you could have all the farmland in the US, 3 companies the size of ExxonMobil, and $1 billion to walk around with. Which one would you rather have? It's a very interesting point. Warren Buffett doesn't like gold. Anyone on the panel enjoys gold? Marwan, what's your thought on gold?
I would just add something small. Like, we have to remember the cost of extracting this gold is around like $900, the all-in cost to 1,000. So when you sell it for 1,200 an ounce, so you're making 20% margin, which is like kind of a normal business for I would say any other business. So it's a producer's business. The utility of gold, as Vinod mentioned, probably is, apart from jewelry, which is maybe 10% of consumption, is nothing above that, I would say.
Interesting. It's a very interesting view. I mean, I think in general, most houses I talk to around the world have a similar view. A small holding, sort of 5 to 10% in a portfolio is okay, but any more than that, you're probably not going to make a huge amount of money. Another asset class that people use, a lot of people think that if you take more risk, you get more returns. Now, that's not always true. A very famous fund manager once said to me, if you take more risk, you know what you're going to get? More risk. He was absolutely right. So a lot of our investors have short memories. We probably remember the 2008, 2009 crash of equities, which frightened a lot of people. Those markets crashed really hard. Markets have been great since then, but still some investors are still nervous because they have short memories and they remember 10 years ago. So I'm just interested to know, if I was an investor today, and I'm nervous of equities because I remember what happened 10 years ago, should I be investing in equities today? Am I guaranteed to lose money? Is there going to be a stock market crash coming? So I'll ask the fixed income guy first, and then I'll ask Marwan, the equities guy. So I can get on the fixed income side. What do you think? Are equities ready for another crash, and should I stay away?
Yeah, look, I think the short answer is no. As I said, every investor's personal circumstances determine how much allocation they need to have to equities. I would never recommend investors to have a 0 allocation to equities at any point of time, or 100% allocation to equities at any point of time. Equities are a very robust asset class. Over a long run, they do generate very attractive total returns. If you look at the S&P 500 in the US, which has one of the longest history in terms of returns, between 1927 and 2007, the average return was 7%. Okay. So for an investor who stays invested in the market, doesn't panic, doesn't try to time the market, there's definitely some attractive returns to be made.
Okay. On the equity side, Marwan, you've been in equities for 12 years. What do you think?
Well, I think there's a lot of emotions when it comes to equities because it's accessible by I would say, as small amounts as $10. So that brings in the volatility to the market. And a lot of time investors forget what these equities represent. They represent companies after all. Yeah. And they start thinking about charts and momentum. This is where a lot of things, I would say, happen. And I'm saying that even for institutional investors, not only retail investors. But again, as Angad rightfully mentioned, if you equity, you go long term. You know, you invest in businesses, you invest in good businesses. I'm sure you're going to be safe, to be honest, over the longer term. But if you have a 6 month, who knows?
Who knows? Yeah, exactly. I'm also interested to know in this part of the world. A lot of people come to me and they say, "Oh well, you know, my nephew works at EMAR, so I think EMAR shares are a great buy, so I'm going to buy EMAR shares." Or, you know, I've heard in the restaurant I was in yesterday, somebody told me that I should buy shares in Aldar or whatever it might have been. You know, should retail investors be buying direct stocks here? Is that a good thing to do, or should they be looking at a different route? What do you think, Marwan?
Well, to be honest, I think if they have, you mentioned something very, very, very good, I believe. In this age, this is information, data. This is what defines risk, not if you take more risk. If you take more risk, you're going to get more risk.
Yeah.
So if you have enough information, enough data to analyze a certain investment, I think you should go with for it directly. But not the guy next to you or your neighbor working there. I don't think that's sufficient enough to make an investment decision.
Yeah.
But on the other hand, I think funds is a great vehicle that is accessible with as low as $100 for many investors who can, you know, get the expertise of financial advisors. So I think that's even myself, when I go invest outside this region, I will go through funds.
Very good, very good. Guys, send us some more questions. We're live on the social media channels. Any questions you'd like to ask us about equities, fixed income, any kind of market questions we have? Here's another question. So we're all professionals, we're in the marketplace. You know, I've been in the industry for a long time, and like you, Marwan, I use funds to make my investments. Are there any kind of investments? I've heard of these ETFs. I haven't really understood what an ETF is, Vinod. What's your view on an ETF?
So, well, an ETF to start with is basically a fund, but it's managed passively, so there's no active involvement by a portfolio manager in terms of taking decision as to what security should be there, should not be there. They just typically follow an index, which is very broad based, and because there's very little active management, the costs are low. Having said that, there's a benefit of investing in an active fund or an actively managed fund, because the fund manager and the research team, the investment analysis team, do bring in a lot of expertise when they research companies, and that expertise is translated into how the portfolio is constructed.
Okay.
And there is a potential to make higher returns than what an index can give you.
So when we mention passive, what does passive mean, and what does ETF actually mean? Can you expand on what does ETF stand for, and what does passive mean?
So an ETF is an exchange traded fund. So the word fund itself tells you it's a fund. It's a portfolio of securities. A simple example is, let's say you want to invest into US equities. Now the S&P 500 is an index which measures the performance of the broad US equity market.
Yeah.
So you could invest into a portfolio that exactly mimics the S&P 500, and that's an index fund or an ETF. An ETF is a portfolio that gets traded on an exchange, so it would be traded on the New York Stock Exchange, and investors could buy and sell at the daily price, which closely follows the value of the underlying portfolio.
Okay, so I've heard people talking about passive investments and AI and robo advisors and all the speed of technology, the speed of information that's moving. And we've seen the markets, we've seen in the last 12 months, we've seen the US market have two really bad months. February last year, it crashed significantly, then it recovered. December was quite bad as well. A lot of people have said to me that, you must blame the ETFs. The ETFs are a time bomb waiting to happen. What's your view on that, Angad? Is that accurate, or is that just a little bit of bad journalism?
I think there's half truth to that. I mean, as you know, as Vinod highlighted, ETF is basically passive money. So on a given day, all it would do is just try to track the performance of the daily equities, and if there's a ETF like mutual funds, if there's an outflow, it doesn't really discriminate between good stocks or bad stocks, or good companies and bad companies. All it tries to do is basically sell everything out in the market. If more money comes into the ETF, it doesn't again differentiate between good and bad companies. It just goes and buys everything that's out there in the market. So that's basically the passive approach of ETFs, and there has been a lot of volatility attached with the fund flows that ETFs have actually experienced. Okay. So I wouldn't say it's completely a disadvantage to the market, but that's definitely it's a factor.
Yeah, my view, I think ETFs are a great thing for retail investors to get into markets that the big ones like the S&P or Europe, but the big developed markets. I think when you're coming down to more emerging markets or more specific markets, I think you need to have an active manager, is my view, because those markets, the ETFs, they don't work quite the same way, and you need to have an active manager who understands that market a little bit more.
Right.
So, no, that's an interesting question. We've had a question in from Yusuf on Facebook. Thank you, Yusuf. Thanks for the question. Asking, in the equity funds and the indexes, how will the Saudi Aramco IPO impact allocation in MENA or GCC funds? Great question, because given its size, Aramco could be huge. We've seen some PR recently about the profitability of Aramco. We all know it's the biggest company in this region, biggest company in Saudi Arabia. What impact will it have? So it's a great question. Thanks, Yusuf. And I think the ideal person to answer that is Marwan. Marwan runs our equity team. So Marwan, what's your views on the Saudi Aramco in the indexes or funds?
Well, it goes back to the strategy, Steve. I think that's the primary question. So Aramco can literally be half of the whole Saudi market.
Half of the Saudi market?
Depending on the valuation.
Wow.
You know, the market now is around 500 plus billion,
Yep.
okay, and Aramco can be valued at 1.4 trillion, even more. Right. So given the free float adjusted, it can be for a significant portion. So definitely it will affect it. Definitely it will drive liquidity. And I would say definitely it will take liquidity from other sectors. But again, if it's an ETF, which is, as Angad rightfully mentioned, it's not price sensitive, probably they're going to follow the Saudi Aramco trade. But for active managers, we are price sensitive after all. I mean, everything has a value.
So you, as an active manager, you're saying that if the price is right, you'll participate?
Sure.
And do you think it will bring more international investors into this region?
Well, I think it will. We have to remember that Saudi is going to be it's already part of MSCI. It's, the first tranche will come in May this year. It's already part of the FTSE as well, Emerging Market Index. So we've seen international, I would say foreign money has reached a peak now in Saudi today, around 3.7% of the market. And
Wow.
these are excluding the strategic investors.
Wow. And I think you're right. And I think, Yusuf, it's a great question because it's the question on lots of international investors' lips. Will that IPO happen is the first question. Secondly, if it happens, what's the value? What's going to be the impact on the markets? And I think, you know, at the end of the day, this region is becoming far more mainstream than it's ever been before. We're starting to see the equity markets in this part of the world being upgraded to global benchmarks, which means that more international investors will have to pay attention to this part of the world, which is great. And on the Aramco story, in fact, I'll just follow on because you probably saw in the last couple of days, Aramco is issuing a bond. Now, that means they're borrowing money from investors. And in my view, as a you know, if I was an ordinary investor, if Aramco came and said, we're looking for people to lend us money, the more people that want to lend money to them is a greater signal of confidence. If people say, no, we're not going to buy that bond, then that's a bad signal of confidence. But I think it's actually been received quite well in the market. So I'll ask Angad just to give us a little bit of background as to what the Saudi Aramco bond means, what sort of confidence levels are attached, and what does that mean for this region?
Yeah, I think you may have read the headlines that Aramco has gone ahead and closed a transaction to buy SABIC from the Public Investment Fund of Saudi Arabia. And the ticket price attached to that particular acquisition is $69 billion. Now, given how cash-rich Aramco is, they should easily be able to fund that transaction. But what they've chosen to do is fund it with cash, but also come to the bond markets to actually come and raise debt. As we speak right now, Aramco is in the process of closing that transaction. The expectation in the market is that they are looking to raise anywhere between $10 billion and $15 billion. And just to give an indication of that token of confidence that investors have, against $10 to $15 billion that they're looking to raise from investors from all over the world, the last book size or the order books were about $85 billion. So it's a very well subscribed bond. There's a lot of confidence that investors have in Aramco. And I think it overall shows great confidence in the Saudi story for going forward.
So you're telling me that the bond issue size, let's say it's 10 billion, but there's $75 billion of investor money chasing that $10 billion. So it's 7.5 times oversubscribed.
That's right.
That's a sign of confidence.
Right.
So that's good for this region. That should help this region get a little bit more international confidence in the global markets. I'll come back to the bond market shortly, but I've had another great question in from Zedri about, again, a great question about the technology and how that's going to affect our industry. He's asked about AI, or artificial intelligence. AI is impacting our lives in ways we don't even know. And 10, 20 years ago, it didn't really exist. The speed of AI and technological advancements now is getting faster and faster. Zedri wants to know, do we think it will impact our role over the coming 10 years? Great question. Thanks for that, Zedri. I'm going to ask Vinod, because Vinod's in the more of the client-facing area. So I'm going to ask Vinod first and see, how do you think it will affect your role?
See, I think AI, or in general, technology is here to stay, and it is definitely going to define the way businesses are going to move forward. Whether it's artificial intelligence, it's digital delivery of solutions, it's robo-advisory, they would all come in. One thing is that all of this technology is going to give you a generic solution. So if you look at it, do I go to a robo-advisor versus do I go to an individual? A robo-advisor or artificial intelligence can give you a very generic solution to your generic requirements. But when you need more specifics, you need a human element to come in. So I think it will be a mix at the end of the day, and businesses that are geared towards adopting the technology are likely to see more advantages or benefits going forward.
I think you're right. I think when we're talking to clients and we're advising clients, you need to have that human interaction. But at the back office side, where there's more trading, maybe the AI and the technology has more impact. And I'll give you an example of that. One of my first jobs when I was very, very young was in stockbroking, a long time ago. And I remember, this is hard to believe, this may maybe give you an idea how old I am, but the traders used to have a big book on their desks. And every time they made a trade, they'd buy so many shares of Shell or BP, they'd write it in a book. At the end of the day, this is where the word ledger comes from. At the end of the day, they'd take these books, take it to the back office, and the back office would type all of these trades into a machine which would send the trades off to the stock market. And at the end of the day, about 5:30, the stock market would send all the contract notes back to us on a fax machine pretty much, which rolled off the contract notes at 5 o'clock at the end of the day. And we'd all sit in the office for an hour translating the ledger to these printouts to make sure they all matched and we hadn't missed a trade. Nowadays, you wouldn't be waiting until 5 o'clock at the end of the day to match up your trades. It's done within seconds. Now, back in the day, I thought, well, technology's coming, we're all going to be out of a job. But the truth is, there's more people in asset management and investments today than there was when I started the industry. So from the trading side and the investment side, Marwan, from your side, how do you think AI or technology will affect your job as an investment manager or a fund manager?
Well, to be honest, it's like generally speaking, anything that can be done by a machine will be say useless to compete with. As you rightfully mentioned, your trading has changed, the machine took over already. But we have to remember today that most of these investment decisions are made by investment managers. All right, so that's a human emotions taking place, and I would think AI will take more than 10 years to understand human emotions. That takes a huge deal, and which we call it irrationality. And even if we believe that it can replace fund managers, we have to remember that these AI computers are buying companies managed by humans.
Yeah.
So again, the human element is still huge, unless companies can be managed by AI, and then you need an AI fund manager. So
That's a good point. It's a good point. Now, Zedra, great question. Thanks for that. And I think the summary of that is, I think that every industry will improve through AI. Our business will improve. We'll be faster. We'll be quicker. We'll be more efficient. And the companies we invest in will be faster, quicker, and more efficient. So, you know what? It should be a really good thing for the industry. And if you look back, I know a lot of people are scared for their jobs. But if you look back at the Industrial Revolution, people were scared for their jobs. And it didn't happen that way. More jobs were created. So great question, thanks very much. Everybody else on the social media channels, please send us some questions. We'd love to hear from you. Anything that's on your mind, please fire it in and we'll do our best to answer. Just back on the bond market, I'm thinking a lot of clients might say to me, well listen, I can get in my bank account, I maybe can get on a 12-month deposit, maybe I can get 2.5%, maybe a bit more. Why should I go into the bond market? What's the point? Angad, what's your view on that?
Yeah, I think the whole objective of investing into bonds is twofold. It looks to give you an enhanced return over and above your fixed deposit. So you could do a 1-year fixed deposit, but if you break that fixed deposit, you actually lose the interest. And the second thing, so which you don't do with bonds, because in any bonds, when you invest, even if you hold it for 3 months, you get your interest for that holding period of 3 months. The second thing is that unlike in fixed deposits, you cannot break it. In the case of bonds, they're fairly liquid. You can go in and out of bonds on a predominantly daily basis. I think one very important thing about the bond market, not necessarily from a 1-year horizon, but from a 2 or 3 or 4-year horizon, is a fixed deposit. When you put money for a 12-month period, you might know what the interest rates are today because you're actually locking in at that interest rate. But 1 year from now, you don't really know what that interest rate is. There's a concept in finance called reinvestment risk, which is the risk associated with the money that you get after 1 year. Where's the interest rate going to be, and where are you going to be able to invest in? The bond markets, on the other hand, they do not completely eradicate that risk, but what it does is it actually reduces the risk given that bonds actually have a 2 or 3 year maturity, and it offers you liquidity at the same time.
Okay, so the bond markets can give you an enhanced rate of return. What happens if somebody, let's say I go to my bank and they say, great, I've got a great idea, there's a great bond, we're going to lend you money, we're going to leverage that bond up for you, so your rate of interest goes even higher. Is that a good idea?
Yeah, I think the whole point of using leverage, whether it's for equities or it's fixed income, it all depends on your individual circumstances. I mean, what the clients have to bear in mind is that the use of leverage can magnify your profits, but it can also magnify your losses. A 2:1 leverage or 3:1 leverage, that means you put $1 and the bank lends you $3. It can potentially enhance your returns, but in a volatile market, when there's a sell-off, it can actually come and give you trouble as well. Okay. So our view on that is it all depends on your individual circumstances. What is your risk tolerance, and how does that particular investment strategy fit into your overall investment profile?
Very good. Thank you. Thank you. Guys, please do send us questions on the social media channels. We're here. We've got a great one in from Zedre again. A general question, just asking us about the banking industry. Is there a trend that we think our competitors are ignoring? Now, obviously we're the asset management team, so it's difficult for us to quote too much about the banking industry, but I think one thing I would say, I mean, in all the time I've been here, I've been with Emirates NBD, working with them for nearly 9 years. And before I joined Emirates NBD, I used their online banking system. And I'll tell you, it's one of the best I've ever used. I used to bank with HSBC, I used to bank with Barclays in the UK, I used to bank with international banks all around the world, but Emirates NBD's online system is very, very good. And I think it developed it further, even with the new Live system. So I think there's more and more coming from Emirates NBD because of the size of the bank. It's not as big as HSBC, but it's big enough in this region to actually make a change. So I think those are interesting trends. I'll just ask, open to the panel, is there any trends that you think our competitors are ignoring, or even trends that we're ignoring as a business?
Well, honestly, the point you touch on is we hear it from even other, we meet with companies and banks across the region, and IT capabilities, I would say, and the online capabilities of ENBD is kind of a benchmark. So I believe this is where most people will try to get.
Yeah, I agree. I always hear good things.
We hear this feedback even from other banks.
Yeah, no, we hear the same thing. In terms of the asset management business, are there any trends in the asset management industry you're seeing at the moment that we think we should be paying attention to, or?
Yeah, I think within this particular region, Emirates NBD Asset Management is one of the largest houses out there, and I think one thing that really differentiates us from our competitors, and something that the competitors also paying close attention to is really choices. Today, investors want choices when it comes to investments. No one just wants to focus on investing within the region, yet at the same time nobody just wants to focus on investing into the US markets. So having engagement with an asset manager where you get choices and the whole suite of investment products, I think it's important.
That's a good point. I mean, Vinod, you're on the sales side, you talk to a lot of clients. Not every client's the same, they're all very different. What kind of choices can we give to a client? What's our suite of products that we can offer to a retail client?
Yeah, so
In terms of the choice of products itself, we are covering regional markets, we are covering some emerging markets, we have got products globally in the global markets on a very diversified basis. From a pure retail investor perspective, I think we've got a fantastic suite of multi-asset products. These are portfolios that are investing globally across the world, across asset classes, equity, fixed income. We've got some alternatives, we manage some cash, we sometimes have a gold investment as a hedge within that portfolio. And these are, we've got 3 such portfolios, and these are all different risk profile for different risk profile clients. So if you are a conservative client, we have got a portfolio for you. If you are an aggressive client, we've got a portfolio for you. If you're somewhere in the middle, we've got a portfolio for you.
So there, I can just put money in one of those funds, and I don't have to worry about where I'm going to invest it. You look after that for me.
So, so these are products where you can sort of match them with your requirements in terms of overall risk profile and return, invest in them, go to sleep.
Very good, very good. And if I had something more specific, let's say that I really wanted to invest in the Indian market, because a lot of my friends tell me the Indian stock market goes up every year and it always makes money. First of all, is that true? And secondly, can you help me to invest in India?
Does it always make money? No, I don't think so. But it's very interesting. If you do believe that Indian markets always make money, yes, do please come into our products. We would love to have you there. On a more serious note, yeah, we have an India product, we have an emerging market product, we've got emerging market debt, we've got emerging market equities, so on and so forth. So, one way in which an investor could invest is what we call core and satellite, and where your core is a multi-asset product that I just mentioned a couple of minutes back, and that forms 60-70% of your portfolio, and the satellite is products which match your views on certain markets. So, if I think Indian markets are good, I may put in a 5 or a 10% of my money in an Indian fund and try to take advantage of the markets, try to and sort of meet my views. But bulk of my portfolio could still be core. So that's one way of investing in. And yes, India market is one of those where we have seen long-term GDP growth being very bullish, very positive. And I think over longer periods of time, clients could make money. But then, of course, each market would have its volatility and clients would have to ride through the volatility. So if you go back to the very initial part of our conversation where we said equities is a 3 to 5 year horizon investment, if you have that horizon, you're fine.
Okay. So I think India's having elections at the moment. Is it right now they're having elections?
Yep.
So
Yes.
is this a great time to buy India? Should I just take this and should I be waiting for this time, or should I wait till after the elections?
So are there elections? Yes. Historically, we have found that election results, and we can show this across different governments over the last 25 odd years, election results don't really have an impact on the market returns going forward after that. So, in a nutshell, the elections will come and elections will go, and therefore investors should take a call on whether or not they like India from a long-term perspective. Okay. Is it a right time to invest? I think some of my colleagues out here could also throw some light on what they think.
Yeah, I think you really have to have a sort of a bird's eye view on India as a market. It's a market that's extremely driven by a very strong domestic consumption story. As the current administration has mentioned quite a few times, India benefits from what they call it as a demographic dividend. There's a natural population growth. A lot of that population is young. They are consuming a lot. And it's growing. I mean, it's given how some of India's peers, China, for example, are now growing at a much smaller rate of 6 to 6.5%. It's the fastest growing emerging market economy in the world right now. Yeah. So it definitely has very strong long-term potential. And for investors who want to take advantage of it, definitely I think it has some promising prospects.
Okay. Well, we talk about India being a large and the fastest growing emerging market. And I think the big famous emerging markets are obviously the likes of China, India, Brazil. We've all heard the big famous emerging markets. And I think there's about to be a new country that will be classified as an emerging market in the next few weeks, and that's Saudi Arabia. Saudi Arabia will be upgraded to what we call the MSCI Emerging Market Index, which is like a club. It's a club of the big emerging markets. In that index, it means that investors around the world will have to put money into that club, and that club will now involve Saudi Arabia. So, from memory, I think India represents around about 6% of that MSCI emerging market club. I'm going to ask Marwan, just what effect, or how big will Saudi be in that club? What effect will that have today on the Saudi market? And will the MENA region form a meaningful part of that emerging market club? And what does that mean going forward?
Oh, that's a very good question, Steve. Well, I would say Saudi coming to the emerging market spectrum will bring huge visibility to the region. Like Saudi today probably going to come in at 2.7 or to 3% depending on the market cap. And that's without Aramco. If Aramco steps in, probably we're going to see that at 5 or even India size 6%.
Wow.
If you add that an expected upgrade for Kuwait as well, if we want to take the GCC as a block together, probably that's going to add another 1%. And then you look at the current other countries in the GCC within that block. So GCC plus MENA can represent at a point with a new foreign ownership opening, like we've seen this with Abu Dhabi Islamic Bank. We expect probably a couple of other banks to follow suit, a couple of other companies to follow suit. So we can talk about 10% in maybe 3 to 5 years, this region representing an emerging market. And this is something I can guarantee you one thing you cannot ignore. Or if you don't want to be here, you need to have a very good, solid reason.
That's interesting, because we travel to the UK and Asia quite a bit, and we talk to investors all around the world about this part of the world. And for the first time in years, they're starting to realize that, as Marwan said, as the MENA region has a greater weighting of that membership, if you want to call it that, of the emerging market club, at some point it could be between 5 and 10% weighting. And if you imagine India is about a 6% weighting, the MENA region could be a meaningful investment destination for foreign investors over the next few years. So watch this space. We think it's a very meaningful and an interesting development. Please guys, please do send us some questions on your social media channels. We've got the guys here waiting to answer any awkward questions you have. I'll take the easy ones, awkward ones across here, but please do send them in. I've had a few other questions that I thought of to ask the panel. One of them was regarding the other investments that we can do. I mean, if we look at the markets today, we've got the US fairly high. It's had a good 3 months. Global markets have done pretty well. The regional markets have done really well. But then we've got the Federal Reserve. The Federal Reserve is the US central bank. And they said just a few weeks ago that actually we're not going to increase interest rates anymore. And from a retail investor's point of view, I'm interested to know, what does that mean for a retail investor? What does that mean for the person on the ground? Is that good news or is that bad news? I mean, Angad, you're probably well positioned.
Yeah, I think, look, the easy question is, a lot of retail investors come and ask us, the US Federal Reserve is going to stop increasing or decreasing interest rates. How does it even matter to us? Yeah. I think we live in a region where the currencies are pegged. They are fixed to the US dollar. How the US interest rates move is how predominantly the regional central banks, who at least have peg currencies, have to move. As the US stops increasing interest rates, more likely than not, the interest rates in this part of the world also should not actually go up. So it's actually positive for consumers that at least the interest rate bills should potentially be on the lower side.
What does that mean for savers, though? If you're saving money, what does it mean if you're a saver?
It's a good point. So the flip side to that is that as interest rates on the borrowing side go down, your deposit rates could potentially come down as well. And that's where it's important that any savings that you have, any investments that you have, is allocated in a smarter way just to generate returns. You have to start looking at equity markets. You have to start looking at the fixed income markets, which have the potential to give you much more enhanced returns versus some of the interest rates, which could actually potentially come down going forward.
Wow. So if you're a saver, potentially interest rates may be coming down. As the US brings its interest rates down, it will affect savings rates here. And the converse to that means that the fixed income markets could be a more attractive place. And what will that do to equity markets, Marwan?
Well, definitely positive. And if you look at, I would say, the easiest way to look at it is the average dividend yield in the market. And as Angad mentioned, deposit rates should start coming down. And actually, if you look at the average 1 year deposits versus December, so we've got now almost 4 months, it's lower by 40 basis points in the UAE on average across the banks, and even 60 basis points in Saudi. So we started to see that effect on the ground of, kind of say no more increase in interest rate. And that should be very good for the equity market, because probably investors now will say, I've got a company X or bank X paying me 6% yield, now it looks attractive again. So that will help the equity market in addition to the fixed income market.
So we're saying that even though equity markets have run quite well in the last 3 months, we're saying that maybe there's still, it's still not a bad time to come in. We're not saying that the market is topped out. There's still maybe some opportunities and it's still worth investing.
Well, you know, Steve, how we think about companies rather than the whole market. So there's a lot of companies, as long as the company is making money, as long as we see earning growth and the potential to increase the dividends, we're more than happy to stay invested. And luckily, there's still a lot of these, I would say, companies out there.
Very good. And if, let's say that I didn't have an awful lot of cash right now, but I think there's a great opportunity and I want to invest. And the question is, should I borrow money to invest? I mean, Vinod, you've been in the market long enough. Is that a good idea?
Yeah, well, borrowing money is a double-edged sword, right? It can work for you, it can work against you. When you meet investors who have borrowed, and of course you always have a story about how well I did when I borrowed money. What investors also need to keep in mind, when it goes against you, you not only lose on your borrowing, you also lose on your own equity, and then you need to pay back to the bank. And we've had several cases where a borrowing has gone wrong, not because the borrowing itself was bad, but because the investment didn't work, the markets moved against the investor, and these things happen. Wow. So you have to be very careful when you're borrowing. Do you really have the capacity to pay back to the bank should your investment go against what you think it would?
So borrowing to invest is something you should be very careful with. I think that's good advice from Vinod. It doubles your risk in terms of upside and downside. So you need to be a little bit careful of that. And in the markets, one question that I get asked a lot here is because in the equity markets here, we've seen the markets liquidity has not been fantastic in the last few months, but these things ebb and flow. Sometimes they're high, sometimes it's a little lower. Some of my clients have spoken to me and said, oh yeah, well these local markets, they're manipulated. They're just there for a few big families to make money and the little guy always loses out. And you could say that about any stock market in the world. And I'm just interested to ask Marwan, have you heard that story before, and what's your view?
I think manipulated is a big word, but I would say realistically and logically, institutional investors have much better access to resources, to information versus the kind of a small retail investor. Yeah. And to be honest, I think it's not fair competition. Like when an uninformed guy puts an order in the market, and this order is being kind of on the opposite side, sits a very institutional investors who probably have access to the management of that company, have access to other investors. So it's unfair. So not manipulated, but I say better resourced.
Very good. No, that makes sense. And I think the markets here are very well regulated and very well policed. So I think that's a little bit of a baseless accusation that they're manipulated. I don't think they are at all. Right, we're almost going to wrap up soon. So any more questions you have from your side, please do send them in. One of the other questions that I wanted to talk about is lots of people in this region need to generate additional income on their investments. It's interesting, as interest rates are coming down, and if your savings rate is going to go down, how can you generate more income? So, I'll ask Vinod, from our suite of products, what would you recommend would be good to generate income?
Yeah, so a straight simple answer to that is our fixed income range of products, purely because these are investments where the underlying securities are paying out a regular income to the fund, and therefore the fund has got those cash flows to pay out to the investor.
Okay.
So you could pick up any of our fixed income products based on your risk profile and your return requirements, and then choose the income share class within that, and you get your income on a periodic basis through those products.
Okay, so in the fixed income markets in this region, Angad, what would be a reasonable income to expect from fixed income markets in this region?
I think it depends on the again sort of risk and return profile of each and every investment. But like in the equity world, where your dividend can range from anywhere from 3% for a very high growth company to a 6 to 7 or 8% for a high dividend yielding company. Similarly, on the fixed income side as well, you could your coupon income or your interest income could range anywhere between 4 to 5% to as high as single digits, depending on how much risk the investors are willing to take.
So coupons or yields around about 4 to 5%?
On average, 4 to 5%.
That's not bad at all. On the equity side, Marwan, what sort of dividends could you expect?
Well, I think one of the interesting aspects about this region is that offers one of the highest dividend yielding on average, because we have a lot of banks as well, which dominates the market and the stock market. So we should expect on average, recently after the strong rallies we've seen last year and this year, around maybe 5%, I would say, 4 to 5%.
Okay.
And again, income generating assets are abundant, like from fixed income to even real estate to REITs. So depending on the risk profile, the liquidity, it differs from one asset class to another.
So I think in general, in our product range, we aim to pay out on our fixed income fund range, we aim to pay out a dividend of around about 5% a year. And on the equity products, I think we aim to pay around about a 4% dividend a year. So there's a steady income flow, and then that is generated, that income is generated by the underlying assets in the equity or the fixed income market. And a question that some people ask me, they say, well, great, I can go and buy an equity and it pays me 4%, or I can go and buy a fixed income bond and maybe that pays me 4 or 5%. Or I can give the money to Emirates NBD Asset Management and ask them to manage it in a fund. But of course that fund is going to charge a fee, an annual management fee. Why should I pay that annual management fee? Why don't I just go and do it myself for free? And I'm not going to pay that annual management fee anymore. Why, why should I do that? So I'm going to ask the guys, ask Marwan first, why do you think an investor should be prepared to pay a small fee to have a managed fund rather than going buying his own portfolio?
Well, first of all, this is inefficient markets in the region. It's dominated by retail, so that creates a huge opportunity. So in a simple way, we should be able to generate above average risk-adjusted return better than the retail investor. That's the first reason. The second reason, he gets access to all these resources, and we save him time and headache. Unless he likes the market headache, So I think that was
no
something.
one likes a market headache. I don't think so. No, I think at the end of the day, you're absolutely right. I've seen funds in the past where the fees have been very high. Some of the funds I've seen have charged 2 or 3%, but the returns have been fantastic. And I've said to a client, that fund has returned you 30% a year, or 30% last year. Do you care what it cost you? If you're going to get those returns, you shouldn't care what it cost you. So really speaking, when you're looking at a fund, don't just look at the fees, look and see what you're getting for that fee, and is that actually good value? And you'll find that most asset managers provide excellent value for money in terms of providing you access to a market, a proper active management for a reasonable fee. Obviously here at Emirates NBD, we don't do anything for free, but we do keep things down to the minimum we can. So now we're almost finished for the session today, so I'm going to say thank you to our panelists. First to Marwan on the equity side, thank you very much. Thank you, Angad on the fixed income side, and thanks to Vinod on the sales side. Thanks for your time. Thanks everyone for your questions. Thanks for watching. Please don't forget any questions that you've sent in that we didn't get through to today. We'll address them a little bit later on. Please stay tuned for the next session. We'll have another session coming up next week on the Ask Emirates NBD social media channel. It'll be a different department. It won't be asset management. We'll be back in a few months' time, but thank you very much for watching.
Smartphones.